All right. What's up, guys? I hope you're doing well. James here from jamesdforsythe.com. So, how exactly are the FedNow master accounts working? This is something that I've been kind of pondering, especially now, and I just wanted to get on here and talk about it quickly, kind of synthesize my thoughts in a way as I've been editing one of the blog posts that I did about, or that I'm doing, I guess, about FedNow, right? Basically, following up the video as well, basically where I was talking about how much FedNow could grow in terms basically between its pilot program and the amount of financial institutions that seem to be or would participate or will participate in mid 2023 whenever it actually comes out. But I was thinking about the master accounts themselves because a lot of people, and it seems to be, how to word it, people are likening FedNow to a CBDC, right? And basically saying, okay, what if we make bank reserves public public tender, right? I think is a term for it. I don't know why the term is elusive to me right now, but regardless. So basically, the argument is, and that's where the kind of whole FedNow as a CBDC kind of gets put in. Now, granted, it is a solution in terms of it's planned to provide a lot of the quote unquote benefits that are kind of also proposed that a CBDC would fix, right? And basically, the thought process is, okay, well, now FedNow is kind of, or can be thought of as kind of the infrastructure for a central bank digital currency, right? As in terms of it being a settlement mechanism. But that's exactly what it is. It's a settlement mechanism. And so what I was thinking about is, in that respect, it is very similar to bank reserves in terms of what it would be, because basically the reserves account of depository institutions at the Federal Reserve are basically just settlement, right? It's a ledger system for interbank kind of interactions, right? Those sort of transactions in which it's to settle between banks, right? But beyond that, it doesn't seem like bank reserves really have much of an effect. And so that's where I was kind of thinking in terms of, these FedNow master accounts, because it's obvious that they aren't going to be just for depository institutions, because then it seems kind of pointless. It's more of, it seems to extrapolate and kind of make a more redundant system, but extrapolate it to encompass other financial institutions and like fintech firms, for examples like PayPal and Square and that sort of thing. Square explicitly stated in there. So thinking about it that way, what if we make those, basically, what if PayPal gets bank reserves? What does that change? In a way, is one thing that I've been thinking of. But also, like, in order for whatever the settlement kind of, it's dollar denominated, but it's also like it's hard to, dollars in what form? So are they bank reserves, or will they just function as bank reserves? And I'm kind of leaning more towards functioning as bank reserves, because it doesn't seem like, obviously they can't be bank reserves in and of themselves, because the payment institutions like Square or PayPal and that sort of thing aren't depository institutions for the Federal Reserve, right? They don't have the stock owned by the Federal Reserve. They don't have the minimum amount of deposits for the Federal Reserve, like all the things that we've talked about that are required to be considered and basically to be chartered into the Federal Reserve System, right? And so basically what I was thinking of, okay, even if that happens, what if you increase, or if the Fed can basically just create and credit these FedNow master accounts, right? How exactly does that change anything? Like, does it do anything, right? And so basically, and I was thinking maybe it's a lot like, in that respect, it's very similar to bank reserves, right? For depository institutions, and it's argued that, like QE is inflationary, which it's not. And you can go through a lot of correlations and stuff that show that as well. And that, for that kind of stuff, I'll cite Jeff Snyder and some of his work, because he talks about that much more in depth. And I don't have the correlations and stuff. And so he's definitely a source you want to listen to in that respect. But that being said, it's kind of like with QE. People think QE is inflationary, but it's not in terms of, and I think it's like money printing, but it's really not. Because if you look in the, from the respect of the commercial bank balance sheet, right? It's just an asset swap. Basically, like what's the Fed doing? They're buying treasuries from, or mortgage-backed securities, or whatever it happens to be, some asset from the commercial bank and giving them bank reserves instead. So from the perspective of the balance sheet of the commercial bank, all that's happening is we'll use an example of treasuries. Their treasuries are being swapped for bank reserves, right? Does it really change anything with respect to what they do? You could argue for like maybe for reserve requirements, but since 2020, those were zero. But even before then, banks don't really need that. If you actually kind of look into how that system works to begin with, because basically all the reserve requirement was for depository liabilities of that bank, right? In a respect, right? There's obviously some other nuances and stuff, but basically the point I want to drive home with respect to that is basically that the banks don't need those bank reserves because they can just go and basically they can go around those regulations, right? They can basically use stuff like money market funds and that sort of thing, or go into offshore banking in terms of like basically utilize the Eurodollar system itself to basically change their depository liabilities into another form to where they don't have to follow up that reserve requirement for those, right? There's so many other ways they could do stuff like this. And that's one of the things I've been looking into a lot the past few days, maybe past week or so, and really trying to understand how that works in terms of, if some bank in London does a transaction with another bank in a different country and they basically can use like another bank in, say, like in New York or something, and how exactly like that works in terms of the different jurisdictions. It gets really complicated really quickly. And that's something that I've been studying more in depth, and kind of why I wanted to bring up this with respect to FedNow, because it's one of those things, it's not ultimately clear, especially with respect to what these master accounts are going to act as. And I think it's one of those, there's also like the theory behind it of how they're supposed to act, and then there's also like, okay, in application, how does this work? And you have to kind of keep that in mind. But I kind of just wanted to put this out there as I was kind of thinking about it out loud with respect to FedNow, and kind of trying to understand a little more, and kind of by discussing it synthesize my thoughts a little better, right? And so also, if you guys have any comments or whatever questions, anything with respect to FedNow, anything I just said, or anything in general, feel free to comment them, and everything you do on YouTube, that sort of thing. That's the whole point of these videos, is to provoke discussion and that sort of thing. So anyways, I'm going to leave this one here. So I hope you guys have a good night, and I will see you on the next one.